Limited liability company write-offs. LLCs account for tax write-offs in different ways. Some are written off in whole on a single year's return. This is the case for most smaller expenses. Other expenses are written off in increments over multiple years. This is called depreciation. Initially applies to large purchases such as expensive business equipment. Depreciation must follow an IRS-approved method. Available tax deductions vary among businesses. For example, the write-offs of an LLC that operates a clothing store are different from the write-offs of an LLC that operates a furniture manufacturing facility. The following are some of the most common LLC tax deductions across industries. Number 1. Placing your children on payroll. When your business is making enough income and you have children that can do tasks that are ordinary and necessary for your business, this is a great time to grow money for your kids tax-free. Many of us know the benefits of having both IRA and that children can have both IRAs. But many taxpayers aren't sure as how to go about the growing tax-free dollars for their children while leveraging a business. When you decide to put your children on payroll, there are no payroll taxes you have to pay on the amounts. You can pay your child up to the standard deduction, which is $12,400, without your child needing to file a tax return. Now, as a business owner, you need to get $12,400 deduction for putting your child on payroll, without having to file a tax return, and no payroll taxes get paid. And on the back end, we can also set up both IRA for your children, place them on payroll, and fund for both IRA through the payroll. This is a way that your children can grow their money tax-free in the market. If you are ready to take control and make sure you are leveraging your business the right way, make sure to work with a licensed tax advisor who can consult with you today. When you are a business owner, you should always be thinking about how you can leverage savings on the things that you are already spending money on. Number 2, equipment costs. As a business owner, you have the ability to write off your laptop and equipment. Most new business owners spend a lot of their money shopping through Amazon and other stores for products and equipments to get their business started. As long as those expenses are considered business equipment costs and not personal expenses, you can receive a tax deduction for it. Also, LLCs that manufacture or resell products can use the cost of goods sold to reduce their tax obligations. Businesses usually deduct the cost of goods sold by adding up the total cost of goods sold for the year and deducting it from the gross receipts. If an LLC deducts the cost of goods sold in this manner, it cannot also deduct that amount as a separate business expense, which would otherwise give the business 2 deductions for a single expense. Number 3, business emails. You are able to deduct 100% of your meals in the year 2021 going forward, as long as there was a business purpose for the meal. As a part of the tax relief bill that was implemented by the Trump administration, as well as the Biden administration, updated law states that if you are a business owner and you choose to conduct businesses in a restaurant or you are ordering food, your business-related meals are now 100% deductible. This means you can write off those meals as long as they are part of your pursuit of income. Make sure that you are tracking your business meals as well as the purpose of the meal documented. The cost of providing meals for your employees at a company picnic or a holiday party are also fully deductible. Number 4, qualified business income. The 2018 tax reform law changed how deductions work for most taxpayers, including small business owners. Under the new tax law, most small businesses, sole proprietorships, LLCs, S corporations, and partnerships will be able to deduct 20% of their income on their taxes. Basically, if you own a small business and it generates $100,000 in profit in 2021, you can deduct $20,000 before ordinary income rates are applied. Be warned, there are a few limits, however, that could prevent you from claiming this deduction. The biggest obstacle is the income limit that applies to some high-income business owners such as lawyers, doctors, and consultants. Once your income exceeds $157,500 for single filers or $315,000 for pass-through business owners who file a joint return, this deduction begins to phase out. You'll want to reach out to a tax pro to see if you're eligible for this pass-through entity deduction. Number 5, home office. If you have turned a spare room in your house or apartment into a home office space, that means you'll probably be able to deduct expenses for the business use of your home, which include mortgage interest, insurance, utilities, repairs, and depreciation. The simplified version of this deduction allows small business owners to deduct $5 for every square foot of your home office, up to a maximum of 300 square feet. But it's important to remember that IRS only allows you to claim this deduction if your home office is used exclusively for business purposes on a regular basis. If your home office doubles as a guest room, that's not going to fly. Number 6, car. A lot of small business owners use vehicles in order to get stuff done, whether it's driving to and from meetings with clients or using a pickup truck to transport heavy equipment from worksite to worksite. If you can prove that you can use a vehicle for business purposes, you can deduct those expenses from your income. Now, there are 2 ways you can claim this deduction. Number 1, use the standard mileage rate. Add up all the miles you drove for your business and multiply by the IRS standard deduction rate to figure out your deduction. As of 2021, the standard mileage rate is 58 cents per mile. So for example, if you drive 5,000 miles for business purposes in 2021, you'll be able to deduct $2,900 off your taxes. Number 2, add up your actual car-related businesses. Now, this option is going to take a little more work. If you keep very detailed records throughout the year, you can add up how much your car depreciated and how much you spent on gas, repair, tires, tune-ups, car insurance, and registration fees. That will be a deduction instead of the mileage. Which option you choose basically depends on how economical your car is, how much it costs you to drive it throughout the year, and how well you documented your car-related expenses. Better save those receipts. Number 7, taxes. Nothing feels better than deducting taxes on your taxes. While you can't deduct federal income taxes, there are still plenty of other taxes closer to home you'll be able to write off on your tax return. For example, you can write off up to $10,000 of state and local income taxes, sales taxes, real estate taxes, and personal property taxes. Here are a few other taxes you can also deduct. Part of your self-employment tax, franchise taxes, excess taxes, occupational taxes. Number 8, debt interest. Listen, we believe that the best way to run your business is to run it completely debt-free. Debt is not a tool to grow your business. It dramatically increases risk. Debt will slowly suck the life out of your business. And if you're not careful, business debt can lead to years of stress, endless payments, and even bankruptcy. If you're thinking about taking out a business loan, don't do it. That's just dumb. But if you've already taken out a loan for business purposes, whether it's a mortgage or a line of credit, you can probably deduct the interest you're paying on the loan from your taxes. But this is one deduction we don't want you to have. Now go pay off that loan as soon as possible and never borrow another cent again. Number 9, salary and employee benefits. If you have employees, what you pay them, from salaries and wages to bonuses and commissions, are tax-deductible business expenses. You can also deduct contributions to their retirement plans, education assistance, and most of the employee benefits program costs. Any freelancers or contract workers that you pay are also tax-deductible. Number 10, depreciation. In some cases, you can write off the full cost of certain property you purchase for business use in the tax year in which you purchased it. This includes the Section 179 deduction, which allows you to deduct the full cost of equipment purchases up to a certain dollar limit. Certain other limits also apply to Section 179 deductions. In addition, there is what is called bonus depreciation allowance, which is another type of write-off in the year costs are incurred. The bonus depreciation limit is 100% for business property acquired and placed in service in 2021 onwards. Another way to claim a write-off for business property is through depreciation. Depreciation means deducting on your taxes a certain allowance each year that spreads out the cost for tax write-offs purposes. Depreciation is calculated based on a method approved by the IRS for allocating a certain amount of the cost each year over time, such as 10 years. Don't overlook remaining depreciation allowances left over from prior years. Check old returns for depreciation opportunities.